Okay, we are live, though we're still in the pregame show. We always go live a minute or two early, so if you're watching this on a recording, we're kind of bantering about for a little bit. Is it raining where you are there in Ogden, Sam?
Oh man, it is it's actually calm right now. If you can see, it's dark. Usually when I'm here I have all this natural light streaming in, but it looks like dusk.
Well,
But
here it's just an absolute frog choker. What was the name of this hurricane that's passing over us now?
Sally?
Sally? At
Yeah,
least
Hurricane
finally a
Sally.
name that I can pronounce. I
Oh,
think
next year if we get to S's, it's going to be Hurricane Sam.
Sam, okay.
Oh yeah.
I,
We
I,
better
I'm,
hope it doesn't
I'm,
come
I'm
to that.
shuddering. I think we are now at 4:30. So officially welcome everybody. Welcome to the 14th happy half hour here with Carolina Retirement Planners. I'm Dave Shakavage, and this is
Sam Shukavage.
hello, everyone. It's good to
Hi.
see you. And remember, if you are here, please say hi in the chat. I can see that Bill has said hi. Miranda has said hi. We won't know you're on if you don't chat, you know?
hmm And we have our wonderful Amy, our client event coordinator. They're handling the chat, so feel free to talk to her. She's amazing and makes all of this happen for us every week.
Behind the scenes, she does all the work. We just sit here with 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 our, well, I like to say our wonderful wisdom, but you might say our meaningless banter. I don't know. It's just sort of,
Depends on the topic. Depends on the
depends on the
day.
topic. Yeah. And what are you drinking today, Sam?
Well, today I am drinking. This is from Wilmington Brewing Company here in Wilmington, and it's an IPA, but it's called Jorts Party. Do you know what jorts are, Dad?
I don't know what jorts are.
It's jean shorts.
Oh gosh. Okay. Well,
So they're
no
a little
offense, but I
cheesy.
was wearing jorts long before anybody thought about calling them jorts. Back in my day, except in my day, we actually took a pair of jeans and cut them off. We didn't go buy one of those, not only go buy one of those jeans, but go buy one of those jeans that someone had machine washed with rocks to make them look old. We made them look old the old fashioned way. We
Oh,
just
now you buy
wore
them
them.
that way. You buy them with big old rips in them.
I'll tell you, I don't know what's going on these days. It's like, just you just wore them out down to the creek long enough, and they look that way naturally.
Yeah,
So
yeah. Oh,
I am drinking my normal
yeah,
herbal.
you
I
never,
know it doesn't
you
look like herbal tea, but it is
never
herbal tea. I promise you, I will make up for it later.
shut. We also have Charlene here. Hey, Charlene, and Brad and Fernando and Ed and Melissa. Hey, Melissa, I think this might be your first time joining us. Barb
Yeah,
and Rick and Clancy. So welcome, y'all.
Barb and Dan. Yep.
Amy told us before we started that today is National Monte Cristo Day.
National Monte Cristo Day.
Do you
You
enjoy
can
Monte?
count on this day. You know.
No, the sandwich, Dad,
Oh, the sandwich,
not the novel.
not the Alexander Dumas novel.
No, the really nice, like, kind of breakfast, kind of lunch. What is it?
Yeah.
French toast
I think
ham?
the Three Musketeers was better though. I guess you could have that for dessert.
Mhm.
Dumas has inspired so many meals. I guess it just over over time. Now, folks, I want to remind you, if you are here down below, it'll say share. And if you click share, you can click on watch party. And what it'll do is it'll send out notices to your friends and that you're on, and they can join us too. So you can get your friends to join you on the watch party and get them to get to know us better too. So we appreciate that. Click share and click watch party. And that's another way to expand the number of viewers we have each time.
We also have Kay and Mike, and Paula is enjoying a watermelon vodka and tonic. That
Ooh,
sounds so nice right
it
now.
does sound good.
Oh my goodness. Robert's here. Robert wants to know if we have any suggestions on how to change from a saving to a spending habit. And that's actually something that we find very often.
Yeah, this is one of this year in particular, people are saving more than they intended because they got nowhere to go and spend it, you know? Although I have spent a lot of money on webinar stuff, I'm spending, I mean, got fancy microphones and all this stuff to make all this happen. It just,
Y'all wouldn't
oh.
believe how many microphones that he has.
And lights, I got lights all over here and it's just funny as can be. And actually, I'll tell you another quick story. You may remember back in maybe the fourth or fifth one, I was broadcasting from a cabin up in the Uwharrie, on the Uwharrie River near Morrow Mountain, sort of near between Raleigh and Charlotte. Well, we bought the cabin. So it's kind of a neat little cabin. Well, I'm up there on last Monday, and I'd gotten a green screen behind me and I'd taken a picture of the office, and Amy translated it into a background. And I had everybody fooled. They thought I was back. I thought you were up in the cabin. And what was really weird is I'm sitting there talking to them and I'm looking at myself and I'm looking at the background and I got to thinking I'm in the office. It just changes your perspective.
You did.
So,
I was one of the people that you fooled. I fell for it.
So earlier today, we held up this sign here. If you watched our preview, and what was the purpose of this topic, Sam?
Well, what do you mean? What's the purpose?
I mean, what did this refer to?
Well, let me get into it.
Okay, let you get into it.
All right. So our topic today is something that people hate to talk about. I think that it just viscerally makes people's skin crawl, and that's life insurance. Well, it's Life Insurance Awareness Month, so we're gonna just grin and bear it and talk about the benefits of life insurance to you.
And we get a lot of questions on people saying, "Hey, I'm 60. What do I need life insurance? What should I use should I keep my life insurance? What should I use it for?" So today we're going to cover a lot of it because there's been a lot of changes in the life insurance industry these past handful of years, rapidly changing. For instance, it used to be to get the benefits of your life insurance, you had to die.
Exactly. You paid all your life for this life insurance, and the only way to get a benefit out of it is you got to croak.
And now you don't have to croak anymore to get benefits from life insurance. It's pretty cool, so.
Exactly. But for real, whenever you were younger, or when you get to the point of retirement, for many people, your mortgage is paid off, your kids have got through college, and you've built a nice nest egg for your retirement. So you're wondering, why do I still have this? Why would we need this? Why do people keep talking about that? And so there are four key reasons. And the easy one is if you have a pension and Social Security drop. So if one of the spouses, if you put together your income plan and you realize that if one spouse dies, the other is going to have a substantial drop in income.
I got a good story there. Let me go tell my story on this one.
All right.
Okay. And I'm going to try to bring on my iPad and see if we can get it working, because it's really nice if I can get the iPad online.
Okay. Well, while you're getting it up, I just want to say hey to Lisa, to Jay and Carter, to Joan, Donna, and Mary, and Lainey came on. It was so nice to talk to you yesterday, Lainey, and Sarah, and Rick, and Jean, and Deborah. So we've got, a lot of y'all are really dying to know about life insurance today.
Yeah. I'll tell you what, while we're doing this, type in if you have life insurance, and if you do, type in whether it's permanent insurance like a whole life or universal life, or whether it's term insurance. Just be interesting to see how many's got what.
And how many people don't know what kind of insurance they have and don't know why they still have it?
Yeah, I got it, and what am I going to do with it? This story goes back about 17 or 18 years when I first switched from being the engineer and moving into retirement planning. And I met a teacher and his wife. And he was a retired teacher. I think he was from New York. And in some of the states, if you're a teacher, you end up paying your Social Security into the teacher's pension. So your Social Security and your pension are together. And I'll tell you, a lot of teachers, they don't make much while they're working, but they often have pretty good pensions. And I think his pension was something like $120,000 a year. So he had a really good pension for him and his wife. And he also had over here in his IRA in taxable money, he had about $300,000. Now, here was the problem. He did this before I met him. If he died, this went to zero. His wife had nothing. She had no pension and she had no Social Security either. So if he died, she was really in trouble. It was even worse if she died right away. All she had to live on was this $300,000 for the rest of his life. So what should he invest that $300,000 in? What would give him the most money right away if he died? And what we began to do is we took some amount, I don't remember exactly, let's call it $30,000 a year, and we moved it over here into a life policy. And the life policy got him something like $500,000 a year of tax-free money if he died.
Not $500,000 a year, Dad.
500,000 total. Thank you. Keep me straight.
That would be insane.
I should be drinking something stronger, keep my head together. But so, this is a case where if you have a pension drop, and this is the worst I've ever seen. Many times people they'll take their pension at a reduced level or it'll go away. Or maybe you were single when you retired and then you found someone later and married but you took your pension one life only. Boy, if he died that first year, she would have $500,000 tax-free, plus most of the $300,000 taxable, and that was going to set her up better. So there's one example how you would use life insurance for a pension drop.
Mm-hmm.
So what else can we use it for, Sam?
Well, Dad, could you unshare your screen, do you think?
Yeah.
That would be helpful. All right. So the second reason that you would want life insurance is because you hate taxes. You want to pass money on to your spouse, to your kids, and you know that the best money to pass on is tax-free money. Mm-hmm. And some things to note about life insurance is that it's not included in your estate. So right now we have an obscenely high estate tax limit. But that could change at any time. So one of the benefits of life insurance is that's going to be out of your taxable estate.
If you position the policy correctly. So you got to put the policy, you could put the policy in your child's name, or you can put the policy in a special trust. But that's one of the reasons we'd often set up trust where the policy would be not taxed, or you could even use it to pay the tax on the rest of your estate, particularly if you had like you had a car dealership, and if you died, you'd have to pay, $500,000 in tax. Now the policy would be used to pay that. So that's another reason. And boy, you put a little in it, instantly you get this much return, so it's like a guaranteed amount that you can't, it's just there.
You have IRA money that you're thinking about doing Roth conversions on, trying to get that over there. But if you know that you're not really going to spend that money, you plan to pass it on, it's smart to take a look at life insurance, because you can double or triple the amount that your beneficiaries get.
It's a much way to leverage it up. And that's what a lot of wealthy families do, is they keep passing on their money by creating big life policies, so the next generation gets another big boost. So
But you know, Dad, these days, like you mentioned, you don't have to die to get the tax-free benefits.
no, you don't.
No, so you can kind of configure it to turn it into a Roth IRA on steroids. You know, you put that money in and you can take it out tax-free. You know, some of the advantages are that you don't have the same, you're not constricted to the same
Mhm.
rules as a Roth IRA. And but the disadvantages are that it really does well when you let it grow for, you know, 10 or 15 years.
Well, I'll tell you, let me go back to the iPad and get into a little more of the weeds, not the weeds, but try to explain exactly how it works.
Absolutely.
So let me see if I can go share this again. Because there's two main ways to set up a policy like this. And one way is you want the policy to go for inheritance. So say I want a policy for inheritance, or as we'll talk about in a little bit, I want it for long-term care. The other way is you can use the policy for your own income. You can turn it into essentially a Roth IRA, okay? If you look at a permanent policy, whole life or universal life, the way it works is there's a certain amount of money in the policy that's basically your cash value. This is the money that you put in and the growth on that money. This is your cash value. And that cash value is also producing interest, which can be used to pay for the death benefit. The company charges you every year for how much money they have to fork out if you die. So this is the death benefit and your charge for that. And usually when you buy insurance to pass money on or, you know, protect against a pension drop, you want to get as much death benefit as you can for as little cash as you can. Okay. And that's one way to set up a policy, and you can design it so that if you pay X amount, 5 payments, 10 payments, that we guarantee that the cash growth will always pay for this death benefit. And you could say lock in $100,000 guaranteed.
Yeah. So in this case, you're just trying to get as much bang for your buck, as much money passed on to your beneficiaries as possible.
Yeah. Now, here's the thing. This cash down here in a policy, as it grows, you don't pay tax on it, just like a Roth IRA or a regular IRA. You don't pay tax as it grows. But when you take it out, if you take it out as a loan, you borrow it out of the policy and the company will lend it to you basically for no interest. They'll be called a wash loan. If you take the money out of the policy, there's no tax on that because loans aren't taxable. And then when you die, the death benefit pays out for the loan. So here's the trick. What you do is instead of putting as little cash as possible in, you want to put as much cash as possible in. You want to fill the policy up with cash and buy as little death benefit as you can. Now, why do you want to do that? Well, because the cost of this death benefit is going to be minimal, and the cash can grow even faster. And now, over the years, you can go in here and you can take out, every year you can take out money, and when you die, the kids basically get what's left of they get the death benefit and the money you didn't take out. The rest is used to pay off the loans. So it works just like a Roth IRA. It's like a Roth IRA on steroids, but you don't have the limits. Like in a Roth, you can only put in so much a year and things like that. And you can't take it out to your 59 and a half. The disadvantage is you pretty much have to let this go for 10 to 15 years before it really starts to pay off, and then it works well.
Once you start one of these policies, like the income policies, are there limits to how much you could put in each year?
No, there are no limits. Now you need
Yes,
to,
there
you
are.
need to kind of be able to, you need to be able to make sure you can make payments. You don't want to put a whole lot of money in the first year and no money the second. You're sizing the death benefit, but it's an alternative to a Roth.
Yeah, the point I was trying to make is that once you set, you have to keep it within a certain limit of a premium each year, or else you turn it into a taxable.
Right. The government says you can't put too much money into your life insurance policy. And when the government tells you there's a limit to how much you can put in, you know there's something good. And that's where there's a certain design to make, we can design these for people so they are within those limits. And so this is a way designed for income. Now, what about long-term care, Sam?
Well, traditionally you would buy long-term care like fire insurance or health insurance. You pay for it, and if your house doesn't burn down, you've lost all that money. It goes away. The trouble is that when they came out, those were underpriced. And if you do still have one, you've probably seen a lot of price increases or decreases in the benefits that they'll give you. And in fact, if you were to come to me today and say, Sam, would you quote me some traditional long-term care insurance? You wouldn't buy it.
I wouldn't buy it.
Yeah.
It's just too expensive for what you get.
But this is legitimately a huge issue for people who are going into retirement, is what happens if I need long-term care. So life insurance companies have stepped in and kind of filled that gap.
And what they've done is they said, look, if you need long-term care, we'll let you spend this whole death benefit and cash all down over, say, 4 years. They've priced it in. They kind of know if you're in a nursing home, or actually sometimes you can do it at home. If you can't do the activities of daily living, you're probably getting pretty close to the end of your days anyway. So they let you take your death benefit early and spend it for long-term care. But the good news is if you never use it, it goes to your spouse, it goes to your kids tax-free. So it's kind of a, you don't use it, you don't lose it scenario, but you got to have some money to put into this in the meantime. You got to have money you're probably not going to use for other things. So,
hey Dad, why don't you go ahead and talk about why don't you go show us Laverne and Shirley?
Okay, so let's do Laverne and Shirley.
We're running a little, we're running a little
we're getting
long.
Okay, so here is,
give away my wine.
So let's say we have Laverne, two ladies. Laverne wants to configure it for, she wants to configure it for long-term care death benefit.
Yeah, and the beauty of that is you say, hey, I want this money. I don't think that I'm going to spend this. I'd like to pass this on to my kids. But one of the things that I'm concerned about is the cost of long-term care. So now you've built that flexibility, and so you have the opportunity to use that if you need it.
So how old is she?
She's 60, and she is of standard health, and she's a non-smoker.
Okay. And how much should we put in?
So Laverne wants to put in a total of $100,000. She's going to put in $20,000 a year for 5 years. She says this $100,000, I'm not going to spend it. I want to go ahead and get this, situated for my inheritance.
And how big a policy will that get her?
That is going to get her a policy of $365,000.
So she's going to get $365,000. And if she needs to use this for long-term care, how much can she get out?
She can take out up to $7,305 a month. She could take less than that if she wants, but that's the most she could take each month.
And how long will it last?
4 years.
4 years. So here it goes. She can get 7,000 a month is a good amount for long-term care, and that will, and what happens if she dies before she uses it all?
The rest of it goes to her kids
So
or her spouse.
anything left in here goes to the family. Okay. So let's go now to Shirley.
All right, so we've got Shirley, and Shirley is really interested in getting some tax-free income. She's also 60, of standard health, not a smoker, and she also has $100,000 that she wants to put away towards future income.
So she's going to put 20,000 a year, 5 years, 100,000.
Mhm.
And so how much death benefit will that get her?
It'll get her $301,000.
So it's a little less because she's funding it more heavily.
Yeah, remember you say you put in the money, you're either emphasizing the death benefit or you're emphasizing the cash within the policy.
So she does this when she's 60. When does she start taking it out?
So we're assuming that she starts taking income from age 75 to age 90.
Okay.
And if she were to do that and try to take out the same amount of a year, she could potentially take out $13,680 a year.
So she gets 13,000 a year. She gets that for 15 years. What is that total?
218,000.
So she gets 208. And is there tax on that 218?
Nope, that is tax-free income.
So it's tax-free because she's taking it out as loans. Now,
And
remember,
after she was done taking that out at 90, if she were to pass, the death benefit would still be $48,000.
so she'd still have 48,000 going to the kids tax-free when she died.
Mhm.
Okay.
And she doesn't necessarily have to take that out as a set amount each year. She could take out $40,000 one year, maybe a grandkid. She wants to help them pay for college, or, she wants to fund a really great vacation. She has the flexibility to take that out and use it whenever she wants.
And God forbid she dies before age 75, they still get $300,000 onto the rest of the family.
Absolutely.
Okay.
And but some of the things, the disadvantages of utilizing life insurance like this is that you really need to be reasonably healthy. You'd be surprised what health issues you could have and still get covered and have it still be effective, but you have to be reasonably healthy. And in the case of the income, it's something that you want to be looking at least 10 years out. The longer, the more advantageous it looks.
Yeah, it's not something short term, and you're kind of making a bigger commitment. With a Roth, you can do a conversion and not do another. But with life insurance, you pretty much got to say, this chunk of money we're going to put over here. And I'll tell you, it's really nice for younger folks. When people come to us with their kids, they say, hey, can you help? We do mostly retirees, but sometimes they say, help my child, and we'll set this up. I had someone who's like 35 and they do this. Man, it really sings. And in the meantime, they got death benefits to pay for their kids if they go to college, if they die, and a lot of other things. So works even better if you're younger. And
absolutely. And if we look forward, if we look into the future and say, where do we think the tax brackets are going? Do we think taxes are going to go up or down? Whenever I'm 65, are taxes going to be higher, do we think? And I think resoundingly yes.
Yeah.
And unless you have an employer who allows you to have a large Roth contribution every year, you're only limited to $6,000 a year. So this is
one or two quick questions. Robert's asking, do you have to go through underwriting before you're accepted? Yep, you have to go through underwriting. Some more hoops, a lot of hoops, not a lot of hoops, but it is something you plan ahead. But if it doesn't work, it doesn't work, and you do something else. So it's just something doesn't cost you anything to find out, And in terms of age brackets, really even into the early 70s, it can make sense. By the way, and I forgot, this is really important. Let's say you have a policy over here that you've had for years and years, and it has cash in it, but it's not one of these new policies that can be used for long-term care. Come here, what are you doing? Get back here. If you can take it, if you're still reasonably healthy, you can take it and you can say, wow, I'm going to move it over to this. I'm going to move it over to this new policy that does have long-term care, and kind of get that old policy doing double duty. So keep that in mind. You got a bunch of money in an old policy, we might still be able to turn it into some long-term care benefits as well. But Sam, we're kind of at the hour. We always try to keep, we could go on and, in fact, there's other types of policies we didn't even talk about here that do even other fancier things, particularly in the long-term care world. But half an hour, I like to keep to it.
We always overestimate how much we can fit into our half hours.
But I thought I could cover this in 5 minutes. What can I say?
My favorite part is our wine drawing. Thank you for those of you who submitted. All you had to do was respond to one of our emails or email us and say, enter me in the drawing. But some people, you can also ask us questions. So thank you to everybody who entered.
Or tell us you referred a friend or held a watch party. We just trying to give Wayne away to everybody, but we want anybody who wants to participate. So, and who is our winner this time?
Well, I'm currently displaced. So I am currently at my in-laws' house. My father-in-law was worked for the Army Corps of Engineers and was stationed in Holland. My husband was actually born in Holland. So while I was looking for something to put the drawing in, I found this adorable wooden shoe. And so I have all the names in my shoe. So our winner this week of 2 bottles of wine, shipped directly to your house, and we give you the good stuff too, is Vicky and Jim. So congratulations, Vicky and Jim. You are our wine winners this week. Join us next week. Remember to just send us an email and tell us you want to get entered in, and we will be happy to enter you.
We will do that. I'm not sure what our topic is next week. We haven't come up with that, but it'll be fun. I guarantee you.
So compelling.
Yes. So everyone, cheers.
Cheers.
Have a good week. See you next Thursday, 4:30 for a happy half hour.